Let's talk more about markets and, of course, what lies ahead. Let's quickly go across to our next guest on the show. Joining me is Feroze Azeez, who's the joint CEO at Anand Rathi Wealth. Feroze, good afternoon. So good to have you back. But since the time we talked, there has been plenty of volatile swings. And now we have US President Donald Trump notifying us about the 10-day ceasefire between Lebanon and Israel. And the outcome of peace talks is something that we'll be watching out over the weekend. So in terms of conflict and market implications, what are your first thoughts when you read the market sentiment?
Good afternoon. When I see the market sentiment, the data very clearly showed back then when the war broke out in the weekend of 26th of February, the Nifty was about 25,178. On your sister channels, I would have probably told it numerous times over the last month and a half since the war has been on. That we analyzed 12 different wars in the past. Every war looks different, but there is something different. There's also something common, that the market's gravity is upwards. So 11 out of the 12 times, markets went back to a level greater by 7% than the place where they started falling from. When the war gets over, the market retraces back that level and retraces, and like how. There's only one instance where the market after the war was over is still 6% lower. This data was already given, but I still say the same thing. You see the markets went to 22,313 on 30th of March. We're back to 24,300. If the entire war were to finish, then you should see levels greater than 25,200. Of course, who's to say how long the war would last? But I think the signs of war coming to at least a slowdown is very imminent. That's one. Second, very important point is whenever market volatility happens, the weaker hands go out of the market. Just like when you saw in COVID, when the Nifty went from 12,300 to almost about 7,600 on a closing basis, you saw that all the weak hands quit in the first 4 or 5 days of such a panic. Then the actual ownership is more solid. So the rallies become so much more solidified because the weaker trading hands are out. So I think that's what I see, that market resilience and lower volatility follows. At least on the lower side, after every massive correction, that's about 25% corrections. There are about 8 instances in the century. Every time the low wall situation on the lower side emerges after a high wall situation, the tunnel gets over. That's called the wall tunnel. I still anticipate the same.
Okay. Does this mean, Feroze, that the worst of the conflict is already in the price? Because so far, Nifty has recovered about 8 to 9% from the March lows.
See, one can't say that. I have analyzed last 26 years. Every year, the market finds a reason to fall 15% from peak to trough. This time, the reason was Iran war. Last time, it was something else. Every single year, average, it has fallen 14.73% from peak to trough. 2026 was a little unusual. The peak to trough so far has already been 14-15% because we went to 26,000. So is the worst over? I don't know, because there's going to be news dependency. Is there a catastrophic fall in the weighting? I saw 2 articles on very, very popular news channel, print media, which spoke of 15,000 and 17,000 of Nifty in that weekend. Okay, just empathize with an investor who's a 5-year, 10-year investor, reads that newspaper and sells, or that article and sells. Then he is out of the market for good, because 17,000 to na aaya, usne 21 22 pe bech diya, 23 pe bech diya. So point is, can the market fall 5, 7, 8% again? It can. That's business as usual. Can it fall 20%? Very unlikely, because big sellers have sold. Big sellers have sold both in the cash market, the derivative market, the leverage, MTF market. If you look at all of these and demand and supply, and there's one more variable which you will not find in India, which we track, is what is the yesterday's cash surplus approximately in debt funds, in equity funds of India. The number is 1,96,216, this give or take. How do we calculate that? That's a separate story. Yesterday, the inflow in equity was 5,464 equity funds. They only deployed 397 crores of cash. So they added to the cash pile 5,000 crores yesterday, domestic institutions. So this is the number I track every day to see whether domestic guys have cash to buy, because those are the only guys who are buying. If they don't have cash, then I would definitely say worst is significantly not over.
Okay, got it. Feroze, then how are you viewing the valuations given the kind of correction we have seen in terms of the conflict? I mean, do you think the kind of inflation and growth risks which have emerged, are you still positive on the terms of valuations that we're trading at?
I think to look at valuation, there are 2 ways to look at it. Of course, an FII is very upset with our valuation, even after the correction, as you can see. because this year or this month also he sold about 45,000 and the domestic guys have bought 34,000. They're upset because they find other emerging markets more relatively cheaper. But one biggest point which one needs to keep in mind is financialization of savings into equity has not happened in India. If there is 1,200 lakh crores of household savings, there's only 6% of that in both direct equity and mutual funds. When there's a flight of capital for a country this large between debt and equity, which seems to be happening, US, Japan have all gone through huge bubbles. 18, 19 PE on Nifty can't be called a bubble, especially when financialization of assets from debt to equity, which has not happened in India, is now happening. So if I spoke to NFI, I said, there, if you're so upset with 18, 19%, if I already had 25% of Indian household savings in equity and I was still at 18, 19, you are absolutely right. But when that happened to Japan, Japan went to a bubble which took 30 years to recover. That's still ahead of us in India. That's one. And second, if the top 10 stocks of Nifty, out of which 5 have given no return for 3, 4, 5 years, that can't be exaggerated valuations. You just look at some stocks in top 10 of Nifty, which is 66% of Nifty, 5 of them have not made money for 3, 4 years.
Okay. So what does this mean in terms of the growth earnings expectations? Because so far we have seen we are into the low single digit earnings growth from the past couple of quarters. So does it justify with the kind of valuations that we are trading in? And of course, going ahead, given that, Q1 is already at risk because of the, Brent crude prices spiking up to above that $100 per barrel.
Yes, that's exactly why you are 8% lower after 1.5 years of time correction. You can't double count the same adversity or double count the same benefits, right? You are, well, of September 2024, we were at 26,200. We are sitting at 24,300 and kind of close today. And that's 18, 19 months of time correction. Earnings have gone up totally for Nifty by about 17% in the same period. I don't look at earnings as a growth number. I look at it as an absolute number. Growths can be deceptive. 1,176 rupees is the earnings of Nifty, which we expect. I personally think after the fourth quarter, that should be possible. If 1176 is delivered, I think we will clock about 8%. Of course, it's lesser than what one would expect. But on a nominal side, we are above 11%, which is the long-term average of earnings growth.
Okay, got it. But if you had to stay ahead, which one would you pick? Would you stay abreast with the large caps, or would you relook at the broad end of the markets, which is your mid and small caps?
I would say small caps. People generally have been telling during this war, I've been saying small cap has got value because Indian small cap definition itself needs to be small, cannot be called small. Because if you have the maximum number of listed companies in any countries in India, and if you look at 500 stocks, which is the NSE 500, is what a domestic guy categorizes as large, mid, and small. What happens to the rest of the 1,500, 2,000, which get traded actively? Those are all called micro caps. Small cap itself, the largest small cap is in more than 50, 60,000 crores of market cap. So I personally think small cap has value, one. Second, I have tracked after the war. There's only one day, which is March 30th, when small caps have had an outflow in India. So Indian investors become far more smarter. Every day in April, small cap funds, which is little over 30 funds, have got a positive inflow, whereas they could have had an outflow. So Indian investor is buying sensibly, not unsensibly. We got 40,000 crores of total inflow, out of which the small cap inflow was the highest for March, and people won't believe that nobody's taking that advice from experts saying don't buy small cap, which is actually a wrong advice because at least 15% of the 40,000 crores have to go to small cap. And I would say small cap has value. So equilibrium of 60-20-20 between large, mid, and small is a great combo.
Okay, got it. Feroze, any themes from the small caps that you're finding attractive at the current levels?
I think the broader market in small caps, I don't think you should do a top down at all. You should do bottom up or buy a index fund or a fund like a mutual fund. I would not recommend themes in the small cap category. Do top down in large cap, do bottom up in small cap. If you're a direct equity investor, look at those stocks, which are those 20 stocks. Even after the war, they didn't fall. That means their ownership is very, very solid. There are 20 odd stocks which were positive at the peak of the fall, which is on 30th March. Those 20 stocks of NSE small cap 250 have actually the hypothesis that these owners are not worried about the market because they've bought the business. So solid ownership is generally established during market correction. So look at these 20, do your bottom-up research and see if there's something interesting out there.
Okay, got it. Feroze, any themes that you want to point out here from the large cap space that you were talking about? Anything that you're finding attractive from the current price point?
I've been saying ABC and D, which was defense. So I think, of course, auto did very well. Then it did badly as well. So banking have gone wrong so far. Of course, private sector banks have disappointed. But I think ABC still continues. Consumption, C stands for consumption. Consumption is one of the sectors which has the decibel of noise, but not the past performance. So that means there is still money to be made in consumption. People generally get very excited with past returns. I think finance tells you that you should be depressed with past returns. So consumption has still not gone right. Doesn't mean that it will not go right. So mean reversion as a principle is what finance textbooks tell you. So ABC still continues, B and C more so than A and D, which is automobile and defense.
Okay, got it, got it. I'll just talk about the A that you have mentioned in the ABC. Feroze, what about the, I mean, do you think, because earlier we did see some reports by CM where they had said that the automobiles are in the precarious phase because of the reduced LPG supply for the current time being, and of course there could be some supply shortages. Do you see this as a risk in terms of production going ahead?
Yes, yes, I think it can. So when I look at sectors, because I only deal as a company with HNIs and ultra HNIs, I'm looking at those sectors which can beat Nifty by 3 to 4% compounded over the next 3 years. That's the premise. I should have told this earlier. So can it give me accumulating opportunity? The answer is yes. If one were to be able to beat Nifty for about by 3.5% for 10, 11 years, you will get as much as capital. If you have 10 crores today, you will beat Nifty by 10 crores in 10, 11 years if you beat it by 3.5%. So my sector calls are not from a perspective of what will happen in the next 3, 4 months. Can this combination beat Nifty by about 3 to 4%? Is the premise on which this has been recommended. So you're absolutely right. Short term, there could be blips, and that's exactly when you build it. You buy low and sell high rather than the contrary.
Okay, okay. What about the D that you were pointing out earlier, defense? How you place there at the current juncture?
Yeah, in that I see some stocks with very low free float, so they're very high beta. So at this stage, I will stay out of them.
Okay, all right, you'll stay out of them. But we have seen a lot of FMCG names have rallied quite well today, and so far this week, the FMCG index has done fairly well. Even in the Q4 business updates, they have mentioned that there could be some certain bit of a recovery from here on. Do you think that this is the one particular pocket which will do well going ahead? Like you were mentioning that it has bullish tone going ahead. Explain us what keeps you this rational going ahead.
I think FMCG, what happens is, of course, some of these stocks, the large ones, especially because they're nifty ones, are not so good. Why are they not so good? Because I also do one study to find out how much of the total free float is owned by index funds. One of them, a couple of PSUs have 22% of the total free float owned by index funds. How do we do that study is a separate story. But I think if you want to do consumption, FMCG, non-cyclical consumption, I would not go as specific as FMCG. Look at one of the funds which has some stocks, HDFC non-cyclical fund consumption stock. In that, that basically is your benchmark. That is a good universe for you to see as a proxy to play the C story directly, which I was alluding to.
Okay, okay, got it, got it. All right, Feroze, with that, we have to let you go, but thank you so much for your time and joining us.